Tuesday, the 20th of September, and welcome to the silver analysis for today. And this is the daily chart. The Fibonacci retracement is within the low of 32.34 and the high of 44.32. So after the big selling that occurred in May, we have managed to barely keep the run bullish and looking as if it wants to eliminate that sort of deal. The previous high in here is lower than this high, and this low, well, it's still above it, but barely. It's pretty much a matching low, which means you can now make a case that we have a double top formation. And a double top is a situation where you pretty much have two cups, like that. And the upper ends are fairly close. If it's a lower one on the second one, that's more bearish, which is the case. And then you have pretty much matching lows. Now, it really does not break the pattern, or it isn't officially a double top until it at least can come back down to this previous low, and that's roughly at around 38 and 2/3. But the bigger level on here will be the 38 and a dime level, which is approximately somewhere in here. That's the more important level for silver to hold. Really, it's a range from 38 and change, or 38 and a dime, to around 42 and a quarter, and that's exactly where we've been in. So I'm looking to see which of these two sides it breaks from, because there's a very good chance that the trend, of course, at some point will change over. And to see this best, we need to go to the quarter-day chart. And within this chart, we have these lows, each of them lower than the previous. And then we have these highs, each of them lower than the previous. So that's the focus we need to see, is the pattern to change. A high that was previous than its last one, or a low that's previous as well as a high. Whichever one comes first is very difficult to state, but when one does come first, it gives you reason to state, okay, maybe now the market's just ready to change directions. For example, if you come up and then we match this low, well, then the moving averages would start to flatten out. Many technical indicators would start to get neutral. And if we have a nice little high, well, then what that means is the chances of making a lower high, or a higher low, would be probable, and the chances of making a lower low would become that of an underdog. But until now, the pattern is still that of lower highs and lower lows. If you connect the trend lines, this is really the main important thing to watch out for. Because as long as it doesn't break this trend line, then there's no reason to expect those minutes where we have 50 cents down in a minute, or we have $1.50 in 20 minutes. Those happen usually when you break this trend line. That hasn't happened, but it's been staying in this range. And a lot of times, especially for those on the short term, because this is what this is, those who play with major leverage, moves like this can be very traumatic and be very detrimental to one's trading account. But again, this is the downtrend range. Breaking either one of these resistance points is going to be very important. Now let's switch this up to a 3-day chart. And within this, we have a situation where after the major short-term crash, the market was using this band of averages as resistance and going below the lows. Then it used it as support, going above the highs. Now it's broke below the 18-period average of closes, and now at the 18-period average of lows. The band is in an upward trend. When the band's in an upward trend, that means that it's bullish. If it's in a downward trend, it's bearish. We do see how the line is flattening out in here and even there. So if it stays here, we're going from cautiously bullish to flat out neutral within this type of time correction. And these corrections can last a long time, and we've barely even seen a long time exist, given that this started on the 1st of May of this year, and it's September the 20th of this year. And I state this because we've had past situations this decade where we have a move where it crashes hard, really maintains the bottom extremely early in the session, and then goes sideways for quite some time. And right now, that has been the case. The previous significant level of resistance is still support. That's what's important on a bullish level, is for the previous resistance to do such a thing. Now, how long it takes or how boring it gets, that's always up for debate. But as far as price action is concerned, whether it takes a week or two for consolidation, which it didn't, whether it takes a few months, which I guess it can, or even a few years, that's really part of the game. Now, I'm getting a lot of comments regarding the article where this one webpage is stating that, well, we're going back down here for support, just a little bounce, then boom. And as much as that's possible, that's all that is possible. After all, we are in a market that is manipulated or is controlled by these central bankers. They print up, or they have all of this electronic fiat and digital currency, that it's sometimes very easy for them to play around with these bid-ask markets and really crush the prices extremely fast. So that's always a option. And the question is, what's going to happen on a 50% move from here? What happens if we do go to 25? What's the psychology going to be like? What's the physical market going to play at? And how's the volatility within the market going to act? Those are a few questions. And myself, I would say that yes, the volatility would be big. And if we do lose 50%, 60%, then the situation from that would increase, would show us that major bottom, something that we seen back in 2008. Within the monthly chart, when we did last have that 50% loss, which was a 60% loss, let's see the price go from 21 down to 8. So it came down, consolidated a little bit, and boom. So is that going to be the same thing? Come down, consolidate a little, then boom? Well, I suppose that would be possible, but again, unlikely, and more likely if it does happen is you have the major volatility moves that happen right afterwards, because when the bottom came in at 846, it really didn't take long to start to have those up moves of 4% a day, 5% a day, and only because the market was down way too much. Now, again, as far as that pattern that they're talking about, which would be down here, and on the monthly term time frame, he went like this. I can't even do that on the monthly chart. It would just be flat out like that. But even still, if we look at a pattern like this, question is, did something like this happen in anything like this before? And, well, here's a situation here where you have this high and you have this low. And you go down and then you go up like this. Sort of like you go down and like that. So there's an example in here which is very similar to in here. And what happened back in 2006 is that it continued to even consolidate a lot longer. For this occurred, the top that is, occurred in 2006, and it happened before the summer. So we'll even say roughly around the same time, 5 years earlier. By the time it finally broke this level, it never happened until after October of 2007, which was over a year. And you need 12 of these to make a year. So 2, 3, 4, 5, 6, 7, 8, 9, 10. You're looking at a year and a half of going sideways, and you established a high, you established a low, and you never touched any single one until you finally broke it to the upside. So the same question again is here. We have this high, we have this low. We set them early, we haven't broke either one since. Question is, which one do we break first? When we break it, will that be a failure or a success? A lot of times the first move could be the failure. In this situation here, it almost kind of was, because you had a bull trap that set up a bear trap, which set up the explosion to the upside. So the question here today is, what's the move going to be, and how long are we going to stay in this sideways consolidation pattern? Alrighty, thank you for tuning in to this video, and have yourself a great day. I'll talk to you later on through the week. Bye-bye.